Like a lot of people, you might be at a point in your life where you want to invest your money in something but are not sure what works for you. Investing is one of the best ways to build wealth and increase your net worth. That's because it allows you to use money you've already got in your bank account to generate even more money for yourself. But investing isn't always as straightforward as it sounds, especially when you're starting out. You might not feel confident about what kind of investment strategy works for you, or how much risk you can take without losing your shirt. We'll go through some of the methods to invest $1,000 in this video. Yes, you heard that right. Even a $1,000 investment has the possibility to grow for you. We'll discuss topics such as earning interest from savings accounts, government bonds, stocks, index funds, and stock diversification. What they are, how they operate, and how they might improve your financial situation. Who became a billionaire the quickest in history? Bill Gates needed 12 years to become a billionaire, while many businesses made billions during the dot-com boom of the 90s, only to quickly lose most of their value when the bubble burst in the early 2000s. Bill Gates, who is still near the top of the list, doesn't look to be losing ground anytime soon. You aim to accumulate stable wealth of that kind. Money can be a difficult game to play. It is extremely competitive, and you can't succeed if you don't know the rules. The issue with most individuals is that they may put in a lot of effort throughout their entire lives, yet they still end up in poverty because they lack the knowledge of how to allow their money to generate even more wealth. In other words, they lack investment knowledge. Assume you've been diligently saving and now have an extra $1,000 in your bank account. That is a success considering that only about 30% of Americans have that much saved in their bank accounts. Let's say that you want to make it grow by investing that money instead of using it to buy another unnecessary accessory or expensive bag that you'll just use once before keeping it in your closet for years, gathering dust. But the real question is, how do you invest your first $1,000? Do you put it towards stock market investments or real estate? How do you choose your stocks? Is $1,000 enough to get started investing? Well, we're going to get into this along with a lot more right now. So, give the video a thumbs up and let's get going. Think about this scenario to help you comprehend what investing is. If you put in a lot of work and save $500,000, you could buy a Lamborghini and show off to everyone. Or you can buy a real estate like a house and rent it out. You could get maybe $2,000 every month. Later, you can sell it and recoup your initial investment if you decide that receiving that $2,000 paycheck each month is something you no longer want. In fact, your house may have gone up in value, allowing you to sell it for more than your original investment. But that is just one small example. Anyway, $1,000 is nowhere near enough money to purchase real estate. It wouldn't even be enough for a down payment. However, what you can do is put that $1,000 into other investments and watch it grow. So, let's take a look at a few simple strategies. Strategy number 1. Buy government bonds. A security called a government bond is one that the government issues to obtain funds to help pay for expenditures. Say the government decides it needs to build a health center but lacks the funds to do so. In this case, the government issues a document stating that the US government owes the owner of the security the sum stated on the paper plus interest. Obviously, this is an oversimplified illustration, but the main idea is still there. The point is that whenever interest rates are low, government bonds are also low. In contrast, several years ago, when interest rates were high, government bonds were as high as 3%, which is not bad considering that government bonds are some of the safest investments you can ever make. Any investment has a certain amount of risk. What are the possibilities that the US government would not repay the loan that you have made to it? The failure of the US economy as a whole may be required for the US government to become bankrupt. This is why it is a nice, safe strategy. Strategy number 2. Savings account. The simplest method is to just deposit it into a savings account and earn interest. But why would the bank reward you for doing that? Should they not be billing you instead? No, the bank will take your money, loan it to someone else at a greater interest rate, and split the profit with you. That is how banks operate. The only issue with this method is that it isn't profitable due to the extremely low bank interest rates. The most you might likely earn is about 1%, which means that if you deposit that $1,000 into a savings account, you will get an additional $10 in 12 months. This is incredibly low because the Federal Reserve tries to keep the inflation rate at about 3%. This means that if your investment does not match at least these levels, over time, the real value of your $1,000 will actually decrease. This would be even worse if the inflation rates were even higher. The returns on our $1,000 have been a bit disappointing so far in this video. Let's start talking about ways we can get way more money from our money. We will also have a special tip later to help you reduce risk when investing. Strategy number 3. Buying stocks. You should think about investing in the stock market if you want to see a bigger return, like 10, 20, or 30%. For instance, in recent years, the stock price of Amazon rose by more than 100%. The price of Google stock also increased by a similar amount. Incredibly, the value of Tesla stock has risen tenfold since 2019. That's right, tenfold. So, why would anyone invest anywhere else when they could potentially more than quadruple their money on the stock market? I'll tell you why. Risk. For instance, there isn't much risk when it comes to government bonds. However, in a single company's stock, there's a chance that the company could collapse or disclose poor financial results. In fact, pretty much any unfavorable news can cause the stock price to fall. A product might be introduced by the company which consumers may not like, and this could result in some bad press, which would cause the price to drop. So clearly the potential for larger returns comes with a much greater risk. Apple is a firmly established business with significantly lower risk of failure than Tesla, but it also has less room for expansion than Tesla. As a result, Tesla's stock price grew tenfold in a short few years, while Apple only increased by a small fraction of that. You must decide how much risk you can tolerate for yourself. If you only have $1,000, it might not be a good idea to risk it all because you could lose the majority of it if things don't work out. Strategy number 4. Investing in index fund. Investing in an index is one approach for investors to reduce their stock market risk. An index fund would essentially invest in these top 500 US companies, since the most well-known one, the SP 500, monitors the 500 largest US corporations. While some of these businesses will undoubtedly fail, others will prosper. According to past data, the SP 500's return rate has generally been around 10% since the 1920s. As a result, purchasing a share of one of these index funds means you are purchasing a modest stake in 500 of the largest US corporations. But how do you purchase shares in these index funds? How do you even begin? You need a broker. This is someone who is qualified to sell you stocks, so you must first identify one. In the past, when you wanted to buy some shares, there was always someone you had to call on the phone. Luckily, those days are gone. Today, we have brokerage companies like TD Ameritrade, E-Trade, and others have developed apps so you can purchase shares from the convenience of your smartphone. You can start investing immediately after downloading one of these apps and creating an account. Strategy number 5. Diversifying stocks. Spreading your investments out will limit your exposure to any one form of asset. This approach is known as diversification. This routine is intended to gradually lessen the volatility of your portfolio. Learning how to strike a balance between your degree of comfort with risk and your time horizon is one of the keys to successful investment. If you invest your retirement savings too cautiously when you're young, you run the danger that your investments won't increase at a rate that keeps up with inflation, and they won't grow to the level you need to retire. The opposite is also true. If you invest too aggressively as you get older, you run the risk of leaving your funds vulnerable to market fluctuations, which could depreciate your assets at a time when you have fewer opportunities to make up for your losses. Diversifying your assets is one method for achieving risk-reward balance in your investing portfolio. Although there are many alternative ways to combine assets under this strategy, the fundamental concept is to distribute your portfolio across many asset classes. Diversification might potentially lessen the quantity and intensity of nauseating ups and downs by minimizing risk and volatility in your portfolio. Always keep in mind that diversification does not guarantee a profit or protect against loss. This video has attempted to address a few of your money investing questions. We know how frustrating it can be to want to start investing but have so many questions. You research everything and eventually give up because there's too much information out there, and you're just too tired to keep going. This happens frequently. Deposit it into a savings account and earn interest. Not great because it isn't profitable due to the extremely low bank interest rates and the inflation rate is usually too high. You can potentially make a lot of money on the stock market, but that carries it with a lot of risk. An index fund would essentially invest in the top 500 US companies. The most well-known one, the SP 500, monitors the 500 largest US corporations. This is less risky than investing in a single company. US bonds are regarded as very safe investments, not too profitable though. Diversifying your assets is one method for achieving a nice risk-reward balance in your investing strategy. Also, diversification will lessen the quantity and intensity of those nauseating ups and downs as we ride that investment roller coaster. Did you enjoy the video? We have a lot more content like this, so check out our recent upload about Make Money Like the Rich by Using Debt 5 Ways, which is linked in the description below. If you found this video helpful, let us know in the comment sections what strategies you're considering about investing.